The Fed raised rates again. Unless you're really into economics and you watch CNBC and you read books, sometimes this may get over your head and you're like, what's the Fed trying to do? All I know is it going to hurt housing? What's it going to do to the economy? Let me explain to you. All right, so what the Fed does is it puts money into the economy and it pulls money out. When it raises interest rates, it's trying to pull money out of the economy. So let me use this visual to help you out. You've got the cost of goods and the amount of goods. The cost of goods will be the dollars. When the Fed lowers interest rates, like it did in 2000 and 2001 to combat the pandemic, it actually sends money into the market. If the supply stays the same, as money enters the market, gradually prices increase. This is what inflation is. And everyone knows what it cost to buy a gallon of milk 2 years ago and what it costs to buy a gallon of milk today. So the demand curve, the amount of dollars moved up, creating price increases. Now what's the Fed doing? The Fed's cutting rates. So what the Fed is doing now, it's taking the amount of dollars that are in the economy and pulling it this way. When it's pulling it this way, the price of these goods drop because we're pulling the amount of dollars that are in the economy out of the economy. So people don't have that money to spend. Now you're saying, well, hold up, Jason. The Fed has not come to my bank account and pulled money out. It hasn't come to my house and asked me for quarters. No, it doesn't do that. How the Fed does that is by raising rates, making it harder for banks to lend. When it makes it harder to banks to lend, it's harder for people to get money because the interest rate's higher, right? So your credit cards, your car loans, anything that's floating that's not fixed gets more expensive. That's pulling money out of the market. You're gonna think twice about buying those concert tickets when your Visa bill is at 25% versus 12%, right? Because that interest you're paying is so much more. That's how the Fed is trying to control how the dollars are in and control the cost of goods. The only thing the Fed is concerned about and watching out is supply. If that supply starts to tighten like it did and they continue to drop the dollars down, it offsets and that means it stays the same. Watch this now. What the Fed's really looking to do is bring down the amount of dollars and do what? Increase the amount of supply. Because when that happens, you've got a whole new paradigm. You've got the supply chart here and you've got the demand chart here, which gives you more supply and at a lower price. That's the Fed's main goal right now. I hope that helps you understand it with the board. Any questions, DM me.